You see the headlines screaming about global conflict, about tensions rising somewhere in the world, and instantly, one single question grabs hold of millions of investors.
And that question is, should I sell everything? It's a totally natural human reaction, right? Your brain is literally hardwired to spot a threat and run for the hills. The problem is, that very instinct, well, it can get you financially crushed in the stock market.
And this right here highlights the huge disconnect. On one side, you have retail investors who understandably panic sell, or they just freeze up, not knowing what to do. On the other side, you have Wall Street, and they operate from a completely different playbook. They don't react to the emotion, they follow predictable patterns and reposition their capital based on where the money is flowing.
And this is so crucial to understand. There's a predictable pattern that markets follow in basically every modern conflict. You look at the Gulf War, the Iraq War, even the more recent war in Ukraine. They all followed the exact same market pattern. So while your fear is completely rational, that instinct to sell is almost always the wrong financial move.
So what is this magic pattern? Well, it's pretty simple when you break it down. History shows us that markets have a very consistent two-step reaction to these shocks. First, they panic. Then, they adapt. Let's dig into the actual numbers. The data here paints a really clear picture. In the first 10 days or so of a conflict, the S&P 500 takes a hit. It typically drops a sharp 5 to 7%. That's the panic. But then, look what happens. About a month in, things tend to level out. And for the investors who didn't panic, well, they get rewarded. 12 months later, the market is typically up 8 to 10%. Let's look at a real-world example, the Gulf War. Get this, even during the actual fighting, the S&P 500 returned nearly 12% on an annualized basis. And in the year that followed, it jumped an incredible 18%. Or how about the start of the Iraq War back in 2003? Despite all the uncertainty in the air, the market actually rallied, posting a 13.6% gain in just the first 3 months, the complete opposite of what you'd expect. And this isn't just old history. The pattern holds up today. Look at the Russia-Ukraine conflict. The S&P initially dropped about 7%, right in line with that historical average. But just a couple of months later, it had already bounced back to a level higher than before the invasion. So here's the bottom line. War itself very rarely destroys markets in the long run. Okay, so we know what happens. But the big question is, how does it happen? Well, Wall Street pros understand this through a simple 3-phase framework. It's what they use to navigate all the uncertainty and, more importantly, spot the opportunities. The framework is a simple 3-step dance: shock, repricing, and rotation. It's how the smart money moves from a place of fear to a place of clarity. Now, as we dive into what each of these phases means, if you're getting some real value out of this data-backed approach, do me a quick favor and hit that like button. And subscribe to the Stock Market Mojo YouTube channel for more insights just like this.
All right, phase 1 is shock. This is that immediate gut punch reaction. It's driven by pure emotion and high-speed trading algorithms. You see oil and gold spike. The VIX, which is Wall Street's fear index, goes through the roof. And anything considered risky, like tech or biotech, gets sold off hard. The most important thing to know here, do not try to time this phase. It is an absolute recipe for disaster. Okay, next up is repricing. This is where the professionals really start to earn their keep. The initial panic starts to fade, and the big institutions, the pension funds, the hedge funds, they start asking the really smart questions. Is this conflict just a blip, or is it a long-term structural change? What does this actually mean for things like inflation, interest rates, and global supply chains? And all of that deep analysis leads directly to phase 3, rotation. This is the big move. It's where money strategically flows out of the sectors that are vulnerable to this new reality and into the sectors that are actually set to benefit from it. This isn't panic. This is patient, informed positioning. So what's the main engine that drives this big rotation, especially when there's conflict in the Middle East? Well, it all starts with the price of oil. Let's trace this domino effect together. First domino, a conflict flares up in a major oil-producing region or even just near a critical shipping lane like the Strait of Hormuz. This creates a perceived risk to the oil supply. Traders immediately start pricing in the possibility of a disruption, and that fear alone is enough to send oil prices shooting higher. Second domino, higher oil prices don't just stay at the gas pump.
See, oil is a key ingredient in almost everything, from transportation and manufacturing to the fertilizer used to grow our food. So when oil costs more, businesses have to pay more. And guess what? Those costs get passed on to us, the consumers. That means higher inflation.
Third domino, now if there's one thing the Federal Reserve is focused on, it's controlling inflation. So when inflation is being stubborn or even rising because of high oil prices, it makes it much, much harder for the Fed to cut interest rates. It pretty much ties their hands. And the final domino falls here. When the Fed has to keep interest rates higher for longer, it increases the cost of borrowing for companies. Whether they're building a new factory or just funding their day-to-day operations, higher interest payments eat directly into their profits. And that is the fundamental reason the broader market can take a hit.
So this brings us to what is easily the most important takeaway of this whole thing. Your job as an investor is not to predict the outcome of a war. Your job is to understand these economic dominoes and position your portfolio for the predictable flow of money that follows. It is all about positioning, not predicting. So, where does the smart money often go? Well, one area to look at is energy infrastructure. Instead of just gambling on the wild price swings of crude oil itself, think about the picks and shovels of the energy sector. We're talking about pipeline companies, storage facilities, and transportation firms. They often benefit from higher prices and volume, but with a lot less of that gut-wrenching volatility.
Next up is the defense sector. And the smart way to play this isn't to chase those short-term headline spikes. It's to recognize the long-term structural case for these companies. The major defense contractors have revenue backlogs, that's confirmed business, measured in hundreds of billions of dollars from multi-year government contracts. This reflects a fundamental shift in global spending priorities. And finally, of course, there's gold. It is the classic flight to safety asset. While oil might be more of a short-term trade, gold often has real staying power. In fact, some fascinating research from Bank of America found that 6 months after a major shock, gold continues to outperform the market by an average of 19%.
When it's all said and done, it comes down to this. Smart investing isn't supposed to be dramatic or exciting. It's about understanding structure, it's about recognizing patterns, and it's about following a set of rules to make calm, measured decisions.
So the next time the headlines are screaming and the markets are diving, how will you react differently now that you have this framework? For more insights to help you stay calm and invest smarter, make sure you subscribe to the Stock Market Mojo YouTube channel. We wish you the best